Hi, this is Jonathan Miller, and welcome to the What It Means podcast. This is my effort to dig into the how and why of the housing market, basically to enable you to sit down at a coffee shop with your best friend and explain clearly what's going on. And there's a lot to unpack, so I'm going to get right at it. First of all, just a little bit about myself for those of you that aren't familiar with us or with me. I am Jonathan Miller, President and CEO of Miller Samuel. We're a real estate appraisal firm based in New York City, and we have been around for, I think, 41 years. It feels like 5 minutes underwater, I think. But we appraise residential, primarily residential, and some small commercial property in the New York City metro area. I'm also the author of the Douglas Elliman Market Report series. I've been doing that for about 30 years. Boy, everything is long term here. And I also teach market analysis at Columbia. I've been doing that since 2018. And I love to talk about different housing markets. So what we're going to try to accomplish here is we're going to go macro at first, sort of big picture, and then we're going to drill down to some markets and then talk about a few other things related to Housing Notes, which is my blog that I publish about 3 times a week that has sort of the, interesting topics of the day that you might want to know about. I've been spending a lot of time talking about tariffs and their impact on the housing market. So you might want to stick around for that. That will be towards the end of this presentation. The first thing I wanted to do was let's talk a little macro first, broader sort of US or general housing market. The first point I want to make as a general rule is there is no national housing market. Every week or every month, you see all kinds of reports coming out from Case-Shiller or NAR's, existing home sales or pending home sales. There is no national housing market. Housing is local. You could argue mortgage rates are national, but really the national numbers are an aggregation of thousands of local markets. Many times, sellers or buyers will see a news heading coming out about a national report and complain or have an issue with maybe the list price you set or your interpretation of the local market. It really doesn't matter. The national stuff isn't really germane to a local property, and that's an important distinction. The big topic, and I don't think I've ever thought that I would be talking about tariffs in my housing discourse like I have been for the last 4 or 5 months. When we think about all the tariff talk or tariff tantrums that we're reading about, hearing about, where we're going to put tariffs on imports that come into the country, and at the same time, people in the housing market are concerned and are hopeful that we will see interest rates fall. And they have been drifting lower for the last couple of months, nominally lower from around 7% on a 30-year mortgage to 6.6-ish. But to see lower rates, the introduction of tariffs are inflationary. I talk to economists almost every day. I've only met, in my experience, 1 or 2 economists. I'd give it 98% of economists in my world think that tariffs are inflationary because it forces the American consumer to pay more for a product. But and this is sort of this crazy sort of exaggerated take on this, but if the tariff actions continue or become more severe, they could actually damage the economy, and in a weird, twisted way, we could actually see interest rates fall as a result, or accelerating the decline. If you remember 4 or 5 years ago, when we had the whole frenzy of activity coming initially during the pandemic and then out of the pandemic, sales activity was booming, and interest rates were very low. The problem with that era is that was sort of a one-off. That I don't think anybody on the planet should be thinking that mortgage rates are going to return to sub 3%. That was essentially the Fed keeping rates too low for too long. And in a sort of a twist to that, when you think about the impact of low rates, we learned during the pandemic, we should have learned, that interest rates, when they're too low, actually make housing more expensive, because it eviscerates it. It just clears the deck of supply. And what we've had in the US, this has been a national condition. Inventory, and I'm going to talk about some local markets shortly, but inventory is the most important metric in housing today. It's more important than sales. It's more important than prices. And the reason is that inventory in most of the country, and I'm going to talk about where it's not, is well below long-term norms. And when you have that happen, and you look at all the housing price forecasts for national forecasts, housing prices are expected to rise 3 to 5% this year, even though mortgage rates are more than double what they were 4 to 5 years ago. How is that possible? Well, the reason it's possible is in the housing sort of process, the home buying process. What you see is a negative external event, like the Fed pivots and starts raising rates at the steepest ascent in history in more than 50 years. Interest rates, or mortgage rates, as a result, have risen very steeply. The problem that has placed on the market is it's made properties less affordable, but prices are still continuing to rise. We've even had, I think Apollo, they originally had a forecast for 2025 of housing prices rising more than 10%. They've reset that forecast to about 8%, but the general feeling is about 3 to 5%. So, it's interesting when you look around the country, inventory is starting, the sort of the picture of inventory is starting to change. We have the Sun Belt states, as the southern United States, are starting to see more inventory come into the market. Why? Because during the pandemic, there was this massive migration event where people moved from the north, especially the Northeast and the West Coast, to less expensive housing locations because they could remote work. The proliferation of Zoom became ubiquitous in about 24 hours, and we had people starting to think differently about where they live and the relationship between work and home. Also, the southern states were very quick, you can build faster in many of the states like Texas and Florida, so that actually in the multifamily world, the rental world, there was an overbuilding that occurred. And there's a general softness in rents in these states as well. So, not all housing markets is the same, as I'm sure all of you know. And inventory is not the same everywhere in the US, but generally speaking, Sun Belt is long-term, sort of consistent with long-term norms. And outside the Sun Belt, north of the Sun Belt, inventory is still chronically low. We released Douglas Elliman released our research last month, or boy, it's been more than a month on markets like Long Island, where inventory is the lowest in history. What does that do to housing prices, right? It makes housing prices rise. So what we're seeing now, and this is what I want to spend a little time with, even though it's the market of Manhattan, which is where we are based, it is emblematic of what's happening in the non-Sunbelt states in the US. We just published today, the first quarter Manhattan sales report. I've been writing this report for Douglas Elliman, feels like since 1492, but I'd say it's been a long time. That was our first report, and we've since expanded. And what we learned in this report is that sales activity is surging in Manhattan. And you wonder, how can that be with interest rates more than double what they were during the pandemic? And actually, just one quick point that I skipped over is, or maybe I said it before, I don't know. This is part of the aging process of losing your mind. But I think what we learned when interest rates are too low, that housing prices are become more expensive because it obliterates. Actually, I did say this, but it's worth repeating that inventory, gets removed. And one other point on inventory nationwide and regionally, when you think about supply, you think about new development or new construction, whatever you want to call it, is typically around 10% of inventory, and resales or existing is 90%. And so even if you tripled new construction overnight, it's still not enough in many markets to sort of normalize supply. Plus, the new inventory coming in tends to be skewed to, say, the upper half of the price spectrum, because new is generally more expensive than existing as a rule. And so when we think about, again, I'm trying to give you some thoughts on, how to, what are the expectations for lower rates? The only way I can see a tremendous amount of inventory coming into the market in a short period of time, north of the southern markets, is if interest rates fall sharply. And then the lock-in effect, which is this idea that if a consumer bought a house or refied 4 to 5 years ago and got a mortgage of they're sitting on a mortgage of less than 3 or as much as 4%, if they become a buyer by listing their home, they also they lose that 3 to 4% mortgage. That's called the lock-in effect. Over time, the resolve of sellers to hang on until rates come down weakens, but it is one of the reasons why inventory has remained relatively scarce. Anyway, enough of that. If we go to the Manhattan housing market, which is something that I said we just released, I wanted to give you some thoughts on that. Even though Manhattan, while the prices here are some of the highest in the country, the activity, supply and demand, all those factors are being replicated across the US. So it is relative to people that don't want to just know about the New York City or the Manhattan housing market. What I'd like to say is, if we think back a year ago, we just finished the first quarter, and actually yesterday was April Fool's Day. It was actually I have 4 boys, and one of my son's birthdays that day. And when my wife was pregnant, the the doctor had to schedule, it was a scheduled C-section, had to, because my son is 6'6", and he was going to the Final Four and had tickets, and basically said, this is the date, even though my wife was worried about it being April Fool's Day. Anyway, and we still always get a chuckle out of that. And also too, just as a quick aside, I've been in a March Madness pool since I graduated from college in 1982 with my roommate and a bunch of my college friends, and now all of our kids. And two of my kids are in the top 3 slots in the pool, and I'm almost dead last, I'm embarrassed to say. So I need to talk more about the housing market to, I think, to cheer up, because my kids are making it hard for me. So when we talk about the Manhattan market, when we think about what's going on, higher rates, the Manhattan housing market is traditionally, over the last decade of data that we have, housing prices, or the housing market has been a 50% cash market, meaning that 50% of the buyers pay cash and 50% finance. Now, when I mean paying cash, I'm not referring to suitcases full of, $100 bills. Most of that is equity drawdowns from the financial markets, and the financial markets don't like tariffs. And we have seen the financial markets generally come down. NASDAQ, Dow Jones, which is, Wall Street is a big employer in New York City, and we've seen a lot of negativity in that regard with the threat of tariffs, and the likely retribution that will come in their wake once they're instituted. So I think that has helped explain the absolute surge in activity that we've seen in Manhattan. Sales are up almost 29% on a year-over-year basis. And like I always say, I prefer looking at year-over-year results, because it does control for seasonality when you're comparing, say, a first quarter to a second quarter. There's implicit seasonality in housing. Year over year, you sort of control that. It's always better to do that, but be aware of the short-term changes as well. What's really interesting, and this is maybe a little bit too wonky, but when we think about the 29% increase in sales, one of the reasons that it was so high is because last year at this time, early in 2024, there was a broad expectation by consumers and seeming everyone on the planet that the U.S. Fed was going to do 3 rate cuts sometime during the year, and there was an expectation of sooner than later. So in the first quarter of last year, many people sort of slowed or paused, waiting for rates to come down, because those sellers would become buyers. As it turned out, that didn't happen. And, the market quickly, saw an uptick in activity in the next couple of quarters. But on a year-over-year basis, the change is a little bit distorted. But clearly, we did see an uptick in sales. If you break it down further and just look at cash versus finance purchases, as I said, the history in this market is, for the last decade, or since 2014, so a little bit more than a decade, it's a 50% cash market. But if you just look at, and we had a 58% of sales this quarter were cash sales. However, if you break it down by units, the actual where we got the extra activity this quarter was more from finance purchases, even though mortgage rates have drifted nominally lower over the last couple of months, and that certainly helps incrementally. But as I said, overall sales were up almost 29%. If you look at cash sales, they were only up 20%. And if you look at mortgage or finance sales, they were up 40%. So the increase in finance purchases, this is, I think we're overemphasizing cash as a driver of this market. Um, we had sales of people that financed on a year-over-year basis. There was still more cash sales, but the rate of increase for finance sales was 40%, which is very large, a very big increase. And then if you take it a step further, a couple of years ago, I was asked, I talked to the media quite a bit, and I was asked in early 23 what the outlook was for 23 for Manhattan. And I had said it was the year of disappointment. And that sort of caught on. There were a couple of headlines that used that title. And I thought it was appropriate because 23, we were a year into higher interest rates. The Fed began in 22, and it was going to be a lackluster, weaker selling market. And that's what it turned out to be. And then a year later, I was asked the same question. What was 2024 going to look like? This is in early January of 24. And I said, it's going to be the year of less disappointment. In other words, it was still going to be underwhelming, but we were anticipating a little bit more sales activity for various reasons. And that is indeed what happened. So in January of this year, a year later, I was asked the same question. And my answer was, it was the year of getting back to zero. And what I mean by zero is I mean that sales activity was going to increase because 3 years is a long time for that couple that bought a one-bedroom condo and had triplets. Life continues to move on, whether you're waiting for lower interest rates or not. And also with the volatility in the financial markets, with all the tantrum talk being thrown around, I think many people were motivated to move sooner than later. And we also have last month in February, the rental market in Manhattan, rents reached their highest level. Median rent was the highest in history, in the mid 4,000 a month range as the median number, which is a big number. And so I think that ultimately, people that were on the fence, perhaps that caused them to push a little bit harder into, thinking about making a purchase. I think the other thing that we saw in the market was, it's not the increase in sales, while it's up 29%, which is a huge number. When we think about the long term, like what I do is I'll compare all the first quarters of the last decade and compare that against the current quarter, so the first quarter going back, and the sales activity in this quarter was about 1.1% higher than the long-term average, or call it similar. And that was my point about getting back to zero, that at least to date, barring some black swan event, some unforeseen situation, that sales activity is normalizing in Manhattan. The same can't be said nationally. And I don't think you can make the argument that Manhattan leads the US. I think it's just a different market. And because of its emphasis on cash, with roughly 6 out of 10 buyers not relying on financing for purchases, that gives it an advantage in a market where interest rates are much higher than they were 4 or 5 years ago. The other sort of minor point, or less minor point, even though I'm sort of contradicting myself, is that inventory was not, we didn't see inventory rise that much. So we had sales go up 29%, and we had inventory go up 7.5%. So effectively, sales rose at 4 times the annual rate as supply. And one thing that's very different about New York relative to the surrounding suburbs, especially the counties that are adjacent, like Westchester County, Fairfield County, Connecticut, and Nassau County, New York, is that inventory is missing from the market. Inventory is very at record lows or near record lows. And as a result, in the outlying suburbs, we're seeing bidding wars in terms of the market. And my definition of bidding war is a home that sells for more than the last asking price. And we did see in Long Island and Westchester, we're talking about one of every 2 sales sells above the asking price. That's my proxy for bidding wars. The terminology is that listings that sell for more than the last ask are, the buyer isn't volunteering to pay more than the seller's asking. They're forced to by the competition, the lack of supply. And like I said earlier, that is the key metric in the housing market. The other thing is that because we're seeing more sales and slower inventory growth, is that the market on the ground feels like it's moving faster. That's a term I refer to called months of supply. And months of supply is the number of months it would take at the current sales rate to deplete all inventory. And in Manhattan, the long-term norm is around 8 months. The national number, of which there's no backing research for this whatsoever, I've blogged about this over the years, is 6 months. And I think 6 months is selected because it's sort of reasonable. We have markets that we cover for Douglas Elliman that are seeing, over the last 20 years, months of supply of 2 or 3 months, and Manhattan 8 or 9 months is normal. So 6 is sort of right in the middle. And that is a reasonable sort of standard to apply. Just know that it's really not, it's not vetted with actual research. And so, the market's moving faster. It feels like it's faster. In fact, the months of supply number in the report is essentially the market feels 16.3% faster than it was the same time last year. And that's because months of supply is a lower number than it was last year, which one other way to think about it, and I don't, sorry to sort of overhype months of supply, but it's my favorite housing metric because it's the intersection of supply and demand. I think about examples like during the housing bubble, where you could look at, if you just looked at inventory and you could see it going to the sky like in a straight upward trajectory, you would think if you were only looking at inventory, boy, the market's really slowing down. But then if you looked at only sales were going upward like a rocket ship, and essentially we're overpowering demand. And so months of supply was a very low number, meaning the market was moving very fast. It felt very fast on the ground. And then we've had, during COVID, we had, Manhattan months of supply exceeding 30 months, meaning it would take 30 months to sell all the supply at the current rate of sales. So the number we're seeing now, again, is this like getting back to normal, getting back to zero. The 8.7 is pretty close to the long-term norm. And I think that's thematic for Manhattan. The other, going on to a couple of other reports, we also published research this week today on the Manhattan and Brooklyn new signed contract markets. And we also publish research in Florida. We have a big presence in Florida, and over the next couple of weeks, we'll be releasing a bunch of research there. But I'll start with Florida first, since we've been talking about New York, is that we cover Palm Beach County, Broward County, and Miami-Dade County. And the three best performing markets, of the three markets, Palm Beach County seems to be the best performing, where we are seeing more new signed contract activity, and that's sort of outpacing new listings. Just to sort of step back and explain what this means. We, in our contracts, new signed contract reports, we're tracking only the contracts that were signed in the month we're reporting. So we just reported March. So the numbers in the report are only reflective of contracts that were signed in March. They're not reflective of, if you had a sale in December and it hasn't closed yet, so it's still a contract. We're not including that. That was already captured in the December report. We're just looking at, for recency. Is that a word? Recency, the most recent sort of take on the market. And the same thing, the other corresponding metric to new signed contracts are new inventory. And new inventory means listings that entered the market in the month we're reporting. So it would be only inventory that entered the market in March. It is not inventory that's been on the market for, more than or longer than the last month. So what we're doing is we're comparing contracts in March versus inventory in March. And basically, we saw in Palm Beach County that contracts were increasing at a faster rate than inventory. In Broward and Miami-Dade, and these reports cover single family and condo markets. And in Broward and Miami-Dade, we actually saw a decline in contracts and an increase in inventory, which reflects a general slowdown in the market. Just a couple of thoughts on Florida in terms of listing inventory. Like everything, housing is local, that we talked about earlier. When you look at listing inventory in Florida on the Gulf side, and I think it's because there's been a number of hurricanes that have come through, inventory growth on the Gulf side is much higher than the ocean side. When we look at markets like Miami, inventory is up. I'm calling this from memory, but inventory is up like 30%, but it's still about 30% below pre-pandemic, 5 years ago. Whereas in the Gulf, inventory is at parity, meaning similar to pre-pandemic or even a little bit higher. And so the logic to it is pricing generally on the Gulf side is lower. I mean, there are some high sales, but generally, if you look at the aggregation of all the single family sales, all the condo sales on the Gulf side, prices there are generally lower than typical markets on the ocean side that we cover from Miami through Palm Beach. And I think that says more about interest rates and being more impactful the lower you go in price or the segment of the market. And the higher that you go in price, the more cash comes into the picture. Miami's ratio of cash to, for example, Miami's ratio of cash to financing is similar to Manhattan, and markets like Palm Beach are 90% to 100% cash for the vast majority of the market. So because the prices there are so much higher, that those types of consumers have access to alternative financing, financial markets, et cetera. That's probably enough of that. The the one thing I wanted to point out about Florida, which is really interesting, is that with the Surfside condo collapse a while back, I took a look at this. I did this a couple of months ago. I think I did this late last year, and I looked at all the sales in Miami by the decade that the buildings they were in were constructed. So everything in the 1970s, 60s, 50s, 40s, and I went down. And if you look at all of them versus you looked at sales over the last that in buildings that were built over the last decade, the newer, the more modern construction is selling at twice the rate as everything else. So the market is somewhat being transformed with more emphasis on new development than I think many people realize. I mean, that's a transition that has been very clear even before the pandemic era. So that's the gist of the 3 reports we released. Next week, we're releasing research on the New York rental market and also 2 boroughs, Brooklyn and Queens. The following week, we're releasing a ton of research on Florida. And then the following week, we're releasing a bunch of research on LA and Orange County, as well as Long Island and the Hamptons and North Fork, which I will share with you on something I want to talk further about, which is housing notes. For those of you, I have a pretty big subscription base I'm very grateful for. I've been blogging at housingnotes.com for about a little over a decade now, but last summer I changed the format of housingnotes.com to singular topics. Before last summer, Housing Notes was this Friday sort of garbage truck of everything related to housing and dozens of charts, graphs. It was just a huge undertaking that I did every Friday morning for like 9.5 years. This summer I pivoted because change is good. I pivoted to a single topic, but more frequent. And I settled on 3 days a week with every Monday, Wednesday, and Friday generally, and a publication, a summary of all the last 5 posts with links. Also comes out on Saturday mornings at 10 a.m. if you didn't catch all the posts that were sent your way during the week. And they cover the sort of ongoing topics of the what's going on in the housing market. So I've spent a lot of time talking about tariffs. Today's post or yesterday's post, depending on when this comes out, is the topic of Manhattan gets back to zero, which is this idea that I talked about just now about how the housing market in Manhattan is normalizing. And in a country that in the U.S. where housing sales have been below long-term norms because of higher interest rates, it's sort of an interesting outlier for now. It'll be interesting to see how much interest rates come down and how much that spurs more sales activity, which is sort of the lifeblood of, it's not housing prices, but sales activity is the lifeblood of the real estate brokerage industry. The other housing note post I wrote was tariff tantrums are getting more pushback than donut holes. You have to sort of find the link that will explain that weird title. But the idea of talking about tariffs and tariffs being inflationary, and why in Trump 2, we'll call it, the tariff usage is dramatically higher than Trump 1, and that's why sort of arguments about Trump one proving that tariffs aren't inflationary is absolutely false. And I've got the receipts. But I hope you'll check it out. It is free, and if you get tired of it, it's one click to unsubscribe. Also, too, I get a lot of readers that send me feedback or commentary, which I anonymize and share every Monday, just to give you a sense of what other people are thinking about it as well. The other, just one last point is this podcast, what it means, which the acronym for that is WHIM. It was done on a whim, but it really wasn't. It's something that I'm just trying to articulate what I put out there in the research, what you're seeing in the market, and what I'm writing about on Housing Notes in this format. For now, this is going to be once a month. Usually it's expected to be the first week of the month. Who knows, maybe we'll have a higher frequency going forward. And also a bunch of announcements coming out about future research and podcasts are in store. But anyway, that pretty much wraps it up. I probably bored you to death, but I appreciate your listenership, and I really appreciate you spending time with me. And I'll leave you with this passing thought that I'll explain on the next podcast that I teach my Columbia students every summer, is that pie is always better than cake. Thank you very much.